The top stories live from the Sky News City studio. The UK's financial watchdog moves to make the UK stock market more attractive to companies. I'll be hearing from its chief executive. Lloyd's banking group profits up by 46% in the first quarter as it benefits from rising interest rates. All eyes on the US Federal Reserve with a 10th consecutive rise in its key policy rate expected today. Plus, the tourism revival continues as Trivago posts a 9% rise in sales for the first 3 months of the year. Good morning, this is Ian King Live, an hour of business and economic news from the heart of the city. Well, the Financial Conduct Authority has proposed simplifying the UK's listing rules to encourage more companies to float on the stock market here. Since 2008, the number of listings in the UK has fallen by 40%, with many companies looking overseas instead. The UK-based chip designer Arm Holdings has opted to list in New York rather than London, while the building materials company CRH and the gaming group Flutter Entertainment are both moving their main listing from London to New York. We'll ask Nikhil, the FCA chief executive, about the impetus for the changes.
We made changes 2 years ago to make it simpler to list, particularly for technology companies. And we opened a discussion at that point around whether we should make any further changes. And so what we've proposed this morning are some further simplifications to move from having 2 segments to 1 segment, make it easier for companies that have recently started to access the public markets, and also move to a more disclosure-based regime so that they can grow and undertake significant transactions faster. That brings with it, though, also more risk. And that's the debate we're very keen for everybody to participate in as we discuss these proposals.
Are these proposals a recognition that what you did 2 years ago wasn't sufficiently radical?
What we did 2 years ago was move to a system which enabled dual-class shares, for example, to be used. We constantly look at feedback from the market, we look at what's happening around the world, and we keep adjusting, and that's the discussion we've been having, and we're now ready to crystallise that debate with new rules. But we're only one part of a much broader ecosystem. So while regulation plays a part, there are many other bigger issues that also need to be looked at. For example, the role of pension funds in the UK and how they allocate risk capital, our culture, our business environment, tax issues, also the access that UK has to overseas markets. All of those need to feature in this discussion.
When you talk about tax issues, is that perhaps a recognition that things like stamp duty on share dealing may have to change?
That's been in the UK for centuries, and we charge 0.5% on every transaction. Different markets tax their transactions in different ways. We just need to understand what the different choices are there. When pensions dividend tax was changed in the late 1990s, that, along with accounting changes, global economic shifts, new products, also changed the incentives for pension funds. All of these things, I think, are ripe for discussion as we look to make sure we've got markets that are fit for the future that enable companies of all sizes to access them.
You mentioned the role of pension funds there. Isn't the main reason that they've fallen out of love with UK equities because they now have a very specific mandate? You mentioned the accounting changes there to match their assets with their liabilities. And the easiest way for them to do that is via bonds.
That's been described as the issue for defined benefit pension funds, and that's part of the discussion. At the same time, we have a very fast-growing defined contribution pension fund system, with over £1 trillion expected from UK savers in that system over the next few years. What's important is that those savings can be allocated to growth and to an appropriate level of risk for UK savers so that savers get the pension returns thereafter.
Are you saying then that the people who manage DC pension schemes are too risk averse?
I'm saying we have to make sure that the right incentives in the system so that the economy gets the financing it needs and savers get the returns thereafter. We have several thousand pension funds, both DC and DB, and there is a question about whether that is the right system to enable investment in long-term infrastructure and growing companies. Other similar markets have many more smaller pension funds, but much larger in scale, able to invest in the expertise and the analysis they need to make long-term investments.
Now, one of the main proposals you're making is to do away with standard and premium listings and just have one class of listing. What are the specific benefits of that?
Investor feedback that we've been getting is that having 2 segments can be a little bit confusing, and having a single route to accessing the public markets with one set of clear rules would be potentially a more attractive model for both companies looking to raise capital and investors. That's the discussion we're opening today. With that, though, comes, as I've said, a transfer of risk to investors. And that's a very important part of the conversation, to make sure that investors understand their responsibilities to hold companies to account, but also that they will be taking on more obligations to value companies and engage with companies.
Well, you're also suggesting that companies listing don't have to produce 3 years' worth of financial accounts prior to doing so. I mean, some people will say that's a recipe for disaster.
These are the choices we're making, but sometimes these startup companies, particularly in the technology domain, can grow incredibly fast. We can see that you can go from having a very low market share in a particular product to a very large, scalable company. So we want to make sure that founders, as they're scaling up, have the opportunity to access public markets. We saw during the pandemic the ability for investors to make judgments around companies and investing in the UK, £34 billion of capital in 2020, even when the accounting certainty wasn't there because of the nature of what was going on around the world. So part of this is a choice for investors to make as to whether they wish to invest in companies of that nature.
Isn't this, though, more to do with the mindset of investors in the UK stock market? I mean, even if you leave aside tech companies for a moment, you look at an established business like BP, it's rated far more lowly than its peers in the United States, even though the quality of its earnings are just as high.
Everybody's going to trade statistics about relative valuations. It's worth bearing in mind that the majority of investors in the UK stock market now are overseas investors who buy stocks both here and in markets around the world. What is important, I think, is that investors also invest in their ability to understand companies, understand their financials, engage with the management of those companies and the boards to get to the appropriate valuation for their risk appetite. The question about risk, I think, is an important one, and the mindset around growth is an important one. One criticism we hear is that firms in the UK find it hard to raise scale-up capital. We think this can help, but this is only one part of an ecosystem. There's also the question of private markets and all of the different spectrum of financing possibilities on the way to the public market. All of those need to be functioning effectively.
Do you think, had these proposals been implemented, it would have been enough to persuade a company like Arm Holdings to list in London rather than New York, or as well as New York?
I think it's very unlikely that a specific regulatory change impacts an individual decision. In the case of Arm, in 2016, when the company was sold, the takeover panel in the UK didn't apply any restrictions to how the capital for that company could be raised in the future. Other countries, like Australia, take a different approach to companies of national importance. We're a global financial centre. We take a much more open approach. But that's also a question, I think, for the government to consider in terms of how it wishes to think about market access and some of these issues around incentives to stay in the home market.
Don't you think the attractiveness of public markets against, say, being private has been watered down by the fact that, for a lot of CEOs in particular, it's not much fun running a public company anymore? Your salary's in the newspapers, all of your time is taken up with sort of corporate governance issues and other various pieces of regulatory reporting that you just don't get on private markets.
Public markets are by definition public. So when you're selling your shares, you are drawing in capital from a wide range of investors, institutions in the UK, around the world, retail investors as well. That comes with it disclosure and accountability. But it can also provide access to capital on a scale that's not available elsewhere. I mentioned earlier during the pandemic, £34 billion of secondary capital was raised in the UK market at speed when companies needed support most to make sure that they could secure their futures, the future jobs for their employees, and the growth that was needed for the economy. So with that access to capital comes a trade-off in terms of transparency and accountability.
I'm getting the sense from talking to you that you really think there needs to be a sort of reappraisal of risk appetites in the UK market.
I think we need to have an honest conversation around the level of risk that we're willing to bear. And the system, as it moves to a more disclosure-based system, if that's where market consensus lands following this discussion, will entail more risk. That means that there is upside for investors, but it also means that sometimes things will go wrong. And that's part of a healthy, dynamic capital market, and we need to, in discussion with market participants, work out where we want to strike that balance.
That was Rathi from the FCA speaking to me a little earlier. Well, later today, the US Federal Reserve is expected to raise its key policy rate, Fed funds, for the 10th consecutive time since March last year. It's expected to raise Fed funds from the current rate of 4.75% to 5% to 5 to 5.25%, which is the highest level in nearly 16 years. The speed with which central banks around the world have raised interest rates has caused upheaval across numerous financial markets and across various asset classes. Well, joining me now, Stephen Cohen. He's head of Europe, Middle East and Africa at BlackRock, the world's largest asset management firm. Stephen, very good morning to you. Before we talk about those macro things, I'd love to get your reaction to what the FCA is proposing. Do you think they'll fly?
This has been a conversation over the last 2-3 years, as we just heard, and I think that the Lord Hill listings review, which really was the kind of culmination and a lot of work in terms of how do you ensure this progression of competitiveness. And I think the UK financial sector is absolutely critical to the UK economy. You've got to keep it competitive, you've got to keep the city competitive, and you've got to balance that with ensuring that you have that strength of governance and regulation, which has always been one of the factors behind the success of the city over the last 30 years. So clearly there's some details in what has been announced this morning we're going to look through in terms of the consultation. But the overall direction of travel, I think, is exactly the right one.
I mean, the central driver for this is that the institutional fund managers, the people who run our retirement savings, like you, have turned your back on UK equities. How do you respond to that?
I don't think we've turned our back on UK equities. I think it's a case of you've got to ensure that the money you're managing on behalf of your clients. Ultimately, we manage, for example, 11 million pensioners. We manage the money for 11 million pensions in the UK. Our job is to ensure that they have the right retirement when they come to retire. So we can look everywhere in the world and to build those portfolios, to deliver those returns. I think the types of things we're hearing today and we've been talking about, hopefully will encourage more companies to grow in the UK. I think the mention around not just about there's a great startup scene. How do you create that scale-up scene? How do you attract that capital? How do you then make sure that companies feel that this is the place they want to list and they want to be long-term? And I think any step towards that is going to make it more attractive for any global investor to think about the UK in terms of that aspect of their portfolios.
I mean, there's a clear implication in all of this that UK investors are slightly risk-averse, but is there a danger that he waters down the regulations so much so that we get all sorts of duds floating on the market that we otherwise wouldn't have?
That's why you've got to find the right balance. And I think they've been steady. Been steady as to how they've approached that. I think there is a strong awareness that governance is absolutely crucial. And as I say earlier on, the UK is known for strong regulatory standards. It's actually one of the things that has attracted capital to the UK. So you don't want to water that down to the point where that goes away. But you do need to balance that, I think, with more competitiveness, with change that actually makes companies and management feel like this is the place for them long term. And if you do that, you're going to deliver ultimately returns. If you encourage more domestic capital, that will encourage more companies to stay. So there is a virtuous circle here, I think they're trying to create.
But why do you think the UK does trade at this discount to other markets? I mean, if you take a company like BP, its earnings are very, very similar to those of, say, Chevron in the United States, yet the latter is valued at far more highly than BP is.
I think you can look at lots of different companies and lots of sectors, and there are very specific reasons why any given company you might see that kind of valuation difference, whether that's specific to the company or whether that's specific to the sector. I think that there is an overall need to try and encourage more UK capital to invest in productive assets. The interview prior just talked about, for example, defined contributions. How do you really activate this huge amount of money that is in defined contribution schemes today and will grow hugely over the coming years? How do you ensure that that is going into productive assets that work both for the beneficiaries but also have that potential knock-on effect that actually you can encourage long-term growth in the UK and again kind of invest in some of those future companies?
Yeah, there's a lot of talk about consolidation of some of these DC schemes. Would that be a magic bullet in your view?
I don't think anything's a magic bullet, but I do think that if you think about where can you take the pension system, anything that allows the pension system to have greater scale, both in terms of potentially reducing cost, but also that ability to run portfolios that are going to deliver better returns, I think is a good thing.
Now, as I mentioned in the introduction, the Fed meets later today. The market's expecting another rate rise. Is it nailed on in your view?
In our view, it pretty much is. I think that clearly a little bit of a wobble over the last couple of days has reduced some expectations. But our thinking is that they will hike today, but then we're probably going to move into a phase of pausing. And I think this is going to be what we're going to see actually for most of the big central banks around the world, including the Bank of England and ultimately the ECB as well, which is that they've done a huge amount. I mean, this is the biggest, fastest interest rate hiking cycle we've seen since the 1980s. So we can't forget that. We're now at a point where actually all of that happens with a lag. So now I think we move into this phase of, as the economy slows into the second half of this year, which we think it will, into what is likely to be a mild recession, as that happens, we think the central banks go on pause. And actually there's an assessment of actually what has been the impact of this hiking cycle that we've seen, including the fact that, as we know in the US, everything that's happened in the regional banking sector the last 2 months is having an impact on credit conditions. And we're going to see that start to play through. And as that starts to play through, that'll do some of the Fed's work as well. The challenge is that inflation is still not down anywhere near their target. And so I think what you do end up, where we kind of disagree with some of the market pricing at the moment, is the idea that the Fed will be in a position, say in Q4, to actually start to cut rates in a slowing economy. Because we just think this core services inflation is sticky enough that it's going to restrict the central bank's ability to cut. So we probably go into a pause and then a hold phase as they assess market conditions.
And do you think that has already started to be priced in by equity markets? I mean, if you look at, whether it's the stock 600 here in Europe or the S&P in the US, I mean, they've all made a really good start to the year.
They've had a fantastic start compared to kind of expectations. Generally, most asset classes have done very well. And I think partly that's because actually economic data, particularly in the US, has been stronger than expected. We've had a lot of support from US consumers. They've been very, very resilient. They're spending down the COVID savings that they built up. So that's one factor. And the second factor is that actually earnings have generally been kind of better than some of the expectations. So we haven't really we're seeing an earnings slowdown, but we haven't necessarily seen the slowdown that many people expected. Now, I think there's still risks in the second half that does start to come through, given what we just talked about. And so that hasn't necessarily been priced into equities at this level. So
you think investors are still being a little too sanguine right now?
Well, it's interesting. I think that these markets are kind of drifting up without a huge amount of activity. And so I think investors are being actually very focused on the reality that, cash offers a lot of high yield now. And so what is the new that's the new benchmark when you think about overall building of portfolios.
Absolutely. I could talk to you all morning, but before I let you go, Activision said last week after its takeover by Microsoft was blocked here in the UK that Britain was closed for business. How would you respond to that?
I don't think Britain is closed for business, but we wouldn't speak about any specific kind of company situation. But broadly speaking, I think that the UK is trying to show that it is open, and I think it's really, really important that it does. And one of the successes of the UK has been cross-border activity, and how do you ensure that that is still the sentiment that is carried around the world?
All right, Stephen, as I say, I could talk to you all day, but we've got to leave it there, I'm afraid. Thanks very much for joining me today. Good to see you. Bit of breaking news to bring you that we've received during the last few moments. And members of the Unite Union, their local government members, are preparing to ballot for strikes this summer after rejecting the latest pay offer. The Unite General Secretary Sharon Graham has said in the last few moments, our members undertake vital frontline roles that ensure local communities are well-maintained, safe and attractive places to live. They've now drawn a line in the sand and will not accept any further erosion of their pay. We'll have more on that story throughout the morning here on Sky News as we get it. Other business news now. And Lloyd's banking group has today reported a pre-tax profit of £2.26 billion for the first 3 months of the year. Well, that was up from £1.5 billion in the same period a year ago and better than the £1.95 billion that the market had expected. The improvement came despite the bank setting aside some £243 million to cover loans it does not now expect to be repaid in full. The UK's biggest provider of current accounts and mortgages said some £2.2 billion worth of deposits was withdrawn during the period, reflecting the competitive savings market and the need for some customers to pay tax bills in January. The consumer healthcare group behind brands such as Sensodyne toothpaste, Centrum multivitamins and Panadol pain relief has hailed the end of Chinese lockdowns for better than expected sales during the first 3 months of the year. Haleon reported sales of £2.99 billion for the quarter. That was up 13.7% on the same period last year, which was helped also by price increases and stronger than expected demand for cold and flu remedies. Well, pre-tax profits for the quarter came in at £542 million. That was up 16.5% on the same period a year ago, but was slightly shy of expectations. The share price is currently off by just over 3%. Barratt Development said this morning that it was continuing to see a recovery in reservations. The UK's largest house builder by stock market value said that reservation activity in the period had reflected the more challenging backdrop for first-time buyers, but resilient demand among existing homeowners. It said the limited homes for sale in the wider market, the energy efficiency of new homes and the backdrop of significant increases in rents had all helped to support demand. And the Chief Financial Officer of RS Group, the components distributor, has resigned after admitting to having had a personal relationship with a colleague. David Egan has been with the company for 7 years, during which time he's twice served as acting chief executive, and the company has been promoted to the FTSE 100. Well, Mr Egan said today, following a detailed review by the board, I recognise that there have been some shortcomings of judgment on my part, and my actions have fallen short of the high standards expected of RS leadership. Therefore, it is right for me to step down from my role. Now, some of the recent results and trading updates from house builders and the builders merchant sector have pointed to a downturn in activity, but there are some operators bucking the trend. Lloyd's Group Trading, a specialist distributor of building, plumbing, heating and DIY goods, today reported a pre-tax profit of £12.8 million for 2022, which was up 69.6% on 2021. The shares are currently ahead by 6.5%. Well, joining me now is the Chief Executive of Lloyd's Group Trading, Shankar Patel. Shankar, welcome to you. I mean, you're focused on the repairs and maintenance and improvement market rather than construction. Do you think that's played to your strengths in this period?
Yes, it has. Our markets are incredibly resilient. RMI, which accounts for 76% of our group revenue, is very supportive of, as the majority of our products are sold, are essential items. And we haven't seen a significant downturn in that as we might have in the house building industry, and in particular anybody who supplies into that sector.
Which are the products most in demand?
At the moment, because we sell a very wide range of products, we do see demand ebb and flow across these categories. Previously, paving, which was a category that did very well post-COVID, is now coming back to its norms. But timber, which had increased in price quite significantly post-COVID, has now dropped in price and again is becoming a leading product category for us. Cement sales, brick sales, whilst not as strong as last year in volume terms, are still holding up in our RMI segment.
That's very interesting. I mean, if I've read you correctly, you're almost saying that you think inflation has peaked in a lot of your product categories.
Across our categories, yes. You still have underlying inflation in products that are energy intensive. Anything that is energy intensive will still, depending on the manufacturer's hedging strategy, may still face some price increases. There are some carbon taxes in some of these products that are flowing through to price increases. But products such as timber and including paving have come down in price. So overall, we're seeing some still continuing, but other product areas coming down in price. So the average increase is not as stark as it was previously in the last 2 years.
And what about your ability to pass on those cost increases to customers?
Thus far, in the last few years, it has been possible. Supply constraint has ensured that for consumers, it's more around availability than necessarily around price, especially with consumers who have committed to products because they're in build. But the side of our business that is quite resilient to product price inflation being passed through is the plumbing and heating, and that is a pure RMI product. We can't see a situation where if you've lost heating in your home or hot water, that you wouldn't want to replace the product that actually supplies that, regardless of whether the price has increased or not. And product price inflation in that area has not been as significant as some of the building materials, which are a lot more energy intensive. So we see ourselves well positioned to be able to pass through product price increases, but hopefully we're now seeing a plateau in the rate of increase, and something more palatable for our consumers and customers.
Now, that's very interesting. Now, one of the interesting things about your business, you are very, very, very acquisitive. I think you've done something like 15 acquisitions over the last 5 years. What do you look for when you buy a business?
So we have three key requirements. One is a locational fit. So if there's a business that's either within our geography but provides us with a bolt-on addition in that geography, that's obviously a business that we would look at. We look at businesses that are well run with decent, branch level management teams, but perhaps with owners who want to now relieve themselves of what we call the burden of ownership. So where there is potentially a retirement or a succession issue, those sort of businesses are well placed for us to take them over because we have a very people-centric focus. Our acquisition strategy is around making sure that the businesses that we buy retain the teams, and actually we grow and develop the teams of the businesses that we purchase. And then another element is product extension. So where we have product specialism that currently we don't have in our group, we look out to see if there's acquisitions that we can make within our disciplined price range that add that specialism to our business. And last year we bought a business in the dry lining and insulation distribution market, something that we're not prevalent in. That's brought a degree of specialism to our business. We bought a business in boiler spares, again something that we didn't have in our collection of brands, and a business that serves the roofing market. So again, we look out for geography, people, and then product expansion.
All right, Shankar, we have to leave it there, I'm afraid. Good to talk to you this morning. Thank you.
Thank you very much.
Now, first-time buyers are looking for smaller properties as mortgage rates continue to rise. Well, that's according to the property website Zoopla. Its latest house price index suggests that while three-bedroom homes remain top of the list for people taking their first step on the property ladder, there has been a shift in demand towards two-bed flats. The average asking price of a three-bedroom first-time buyer home is now £230,000, while the average price tag for a two-bedroom property is around £210,000. Well, joining me now is Richard Donnell. He's Executive Director at Zoopla. Richard, welcome to you. I mean, the big thing that jumped out of the results or the index for me is that buyer demand is down 42% year on year. Why is that down to interest rate rises?
Yes, it's all down to the strength of the market over the pandemic. That once in a lifetime, re-evaluation of the housing you need. So yes, year on year metrics in housing don't look great. But if you compare back to, say, a normal year of like 2019, actually buyer demand is holding up much better than you'd expected at the end of last year.
Yeah, I mean, it was interesting, that statement from Barratt Development sort of touched on earlier in the programme. Reasonably resilient state of affairs. Is it cheaper, though, now to buy than to rent?
Well, for first-time buyers are a really key audience group for house builders. We've had Help to Buy, that's now ended. I think in many markets outside London, the South East, a renter looking to buy the home they rent, their mortgage repayments would be up to 30% less than their rent, even at 4% and 5% mortgage rates, as long as they can come up with that deposit. And that's the biggest constraint on first-time buyers. And I think we're seeing sales volumes improve. Demand is down, but the run rate of sales being agreed is 15% above the 5-year average. So there's a motivation to move out there, even though we've got much higher mortgage rates.
Yeah, and yet affordability for first-time buyers, who are the lifeblood of the market, is clearly becoming an issue.
It is. I mean, to be a first-time buyer now, you need to be on about 55,000 household income. This is why we're seeing this shift into smaller properties. But first-time buyers are also taking longer mortgage terms, which gets you up to 20% more buying power today, but you end up paying your bank 50% more in mortgage interest payments over the life of your mortgage. And I think working from home also gives people more flexibility. Rather than waiting for longer to buy near work, you can now, for those that can work flexibly, look further afield.
Yeah, interesting. Now, one of the other things that jumped out in the report today is the fact that 1 in 4 properties has seen the asking price reduced. When did you last see those sort of conditions?
Well, that's just getting better, actually.
Right.
We've just seen quite a big repricing of asking prices. The market was so hot over the whole of the pandemic. People were getting 100% of the asking price or even higher. The market was just so strong. And actually, the real price recorrection has happened with sellers, just having to get realistic again now and take a discount of up to 4 to 5%. So whilst homeowners made 45,000 over the pandemic, on average, they're having to give away 15,000 as a discount. So they're still up. But yes, there's a repricing. We think the worst of the price falls are over now. And I think we're going to have a pretty soft recorrection in house prices.
So no big correction. I mean, when you talk about a soft correction, what do you mean?
We think this year prices are going to be flat to down by 1%. But as I say, it's that widening of the discount to asking price that's taking a lot of the strain.
In the face of all these interest rate rises?
Well, I think mortgage rates have come down to sort of averaging about 4 to 4.5% now, and the fact for many first-time buyers outside London, the South East, it's cheaper to buy than to rent. It shows the resilience in the market, and I think a lot of the policy changes introduced by the Bank of England, the limits on loan-to-income, the affordability stress testing, have provided a much more resilience to higher rates than you would have expected. And it's probably good news we've had that regulation and has saved us from an overpricing and then a recorrection.
I think you're slightly at odds with the likes of the Halifax, though. They're a bit more bearish than you are.
Yeah, I think a lot of the banks have put out, I think Santander last week said 10% price fall. So I think that's for sort of economic modelling and capital modelling purposes. We're just trying to look at what's really going to happen in the market. And we can see from our own data that the market's just more resilient than economic models might have suggested.
I think a lot of people will be very pleased to hear you say that, Richard. Good to see you this morning. Thank you. Still to come here on Ian King Live. We're going to have a look at how the markets are doing this Wednesday morning. Stay with us. That's great. Thank you.
So we went to the Yorkshire Three Peaks, and there were 68 of us who attempted to do the Three Peaks. Some of us managed the Two Peaks, and actually quite a big group managed the Three Peaks. We had the most horrendous weather. It really was the hardest challenge we've ever done as the charity. And I mean, from 5 miles in, we were walking in puddles inside our shoes.
Wow.
It was just wet completely through. And I think to see all these people do this walk, and I had one of the guys who did it text me afterwards and said, look, I got to the top of one of the mountains. I thought, I can't do any more of this. But then I thought about Ian and the boys, and I thought what they'd been through, and with them in his mind, it just kept him going.
You're raising money, so they can donate money, can't they?
Yeah, they can donate money through our page, which I can't remember the...
OscarsPBTC.org. Yeah.
Say that again, that's quite complicated.
OscarsPBTC.org.
OK,
yeah.
Fine, we'll make sure that we put that on our Twitter a little bit later on. Tell
They
me...
can take part in the events as well, can't
Yeah,
they?
tell
We
me
do
about...
a
I
lot
was
of
going to
things.
ask you about other events. What other events have you done?
We've done Snowdon a couple times, Scarfell, and then last year we did Ben Nevis.
Did you? Which did you find was the trickiest?
Out of all of them, Ben Nevis.
Did you?
But this one's definitely taken the top of the hardest.
Because of the weather, do you think?
Yeah, probably.
Yeah, it sounds as though it was really, really difficult. How much money do you think you've raised for this charity?
I'm pretty sure we've raised about £20,000.
Wow, that's amazing.
I think if we make it past £22,000, it'll be the event that's raised the most money for us ever.
Welcome back. A bit of breaking news to bring you on the sporting front. In the last few minutes, we've learned that Leeds United has sacked its manager, Javi Gracia, and he's been replaced, as the newspapers were widely predicting yesterday, by Sam Allardyce. Leeds, of course, have only 4 matches left this season, and I think the first of them is against Manchester City. So, Big Sam, no pressure there. On to the markets now. And last night's sell-off on Wall Street was followed by declines over most of the Asia-Pacific region overnight. Shanghai was the only major market in the region to post gains. You can ignore Tokyo, which is in the top left-hand corner of the screen there. That is closed for a public holiday. Sydney was off another 1% following yesterday's unexpected interest rate rise from the Reserve Bank of Australia. Well, in Europe, equities have been largely in positive territory this morning following some reasonably good company results. As you can see, only the IBEX in Madrid is in negative territory right now. Talking points on continental Europe this morning include UniCredit. Italy's biggest bank is up nearly 6% in Milan. It's 5% now, and that's after its quarterly earnings beat expectations. Well, here in London, the FTSE 100 has all been in positive territory for most of the morning. It's 14 points to the good right now, led by some of the consumer and mining stocks. The leading blue chip gainer right now is Pearson, which is currently ahead by 9%. It fell by 15% yesterday following a profits warning from its US peer Chegg. On the downside, well, I mentioned RS Group earlier on, the departure of the Chief Financial Officer. That's clipped 2% from the share price there. Outside the FTSE 100, TI Fluid Systems is ahead by some 15% following a trading update, but Aston Martin Lagonda, the shares there, are off some 2%. That's despite the company reducing its quarterly losses. On the foreign exchange market, well, the US dollar has been on the back foot following news that US job openings fell for a third straight month in March. As you can see, sterling is ahead by nearly a third of 1% against the greenback. It was up by more than that earlier on. The pound unchanged against the euro. The single currency, meanwhile, similarly up by just over a third of 1% against the US dollar. As for the oil price, well, that this morning hit its lowest level since the 24th of March, amid growing concerns over demand following expected interest rate rises this week. A barrel of Brent crude will currently set you back $73.94 a barrel. That is off a little under 2% on the session. Well, joining me today is the head of investment at Interactive Investor, Victoria Scholar. Victoria, good to see you this morning. Let's start with Lloyd's. Fairly good set of numbers, I thought. The share price has barely moved.
Yeah, you're right. We saw that quarterly pre-tax profit figure beat expectations. On the one hand, it's been benefiting from the rising rate environment, which has clearly helped to boost its bottom line through higher returns on lending products. But on the other hand, there's the macroeconomic backdrop to contend with. There's a growing risk of loans turning sour. Businesses and individuals could find themselves in financial trouble. So to prepare for this, Lloyd's has been upping its provisions for potential bad loans, possibly why the stock is not particularly moving higher or sharply lower. Lloyd's also suffered from heavy deposit outflows because customers are looking elsewhere, browsing around for more attractive savings rates in a rather competitive market at the moment. And then, of course, there's the backdrop of the turmoil in the banking sector, which has weighed heavily on the US mid-sized banks yesterday, but has been weighing on the sector more broadly globally in the last couple of months.
Now, also updating the market today is Haleon. I mean, the thing that struck me here, Victoria, is the ease with which this company has been able to pass on price increases. I mean, it's another illustration, I guess, of why inflation remains elevated despite all these rate hikes.
Yeah, you're right. We've heard this so many times about companies passing on these additional cost pressures to consumers in terms of higher prices. But unfortunately, that didn't translate into stronger earnings. Its first quarter adjusted earnings per share missed analysts' expectations. And a lot of its sales growth has been driven by price increases rather than volume growth in its key markets. And its profits margins actually got squeezed despite this shift higher in terms of prices. So that's kind of ringing alarm bells and possibly why the stock is under pressure today.
What did you make of Barratt Developments? Again, I mean, I thought that was an easy as steady as she goes trading update. Again, the shares have barely moved today.
Yeah, I mean, it says it's on track to deliver full year profits and it achieved pretty good, strong forward sales, but they are down year on year. Clearly, the housing market is under pressure, still reeling from the mini budget after mortgage rates were soaring. But, we had that nationwide house price index out this week that pointed to a tentative recovery. And the stock and other stocks in the sector are up quite sharply this year. I think Barratt's up about 20%, widely outperforming the FTSE 100, with investors trying to kind of look ahead to the potential for a rebound in the housing market as the Bank of England approaches the peak of the rate hiking cycle and as inflation hopefully starts to come down in the months ahead.
Now, what did you make of the rally in Pearson this morning, Victoria? I mean, it was absolutely extraordinary fall yesterday, really on the back of one of its peers in the US saying it was worried about weakening demand on the back of ChatGPT.
Yeah, well, this was a stock that was very much one of the winners of 2022. I think it was one of the best performers on the FTSE 100 last year, but it seems to have fallen out of favour this year. It wanted to position itself as the Netflix for education publishing, a subscription service for all those sort of education needs online. But it does look as though the sector is now facing pressures from AI, like you say, ChatGPT weighing on its rival with a potential read across for Pearson as well.
Now, what about the US Federal Reserve, Victoria? I mean, we heard from Stephen Cohen in BlackRock earlier saying he thought it was nailed on another rate hike tonight. Is that your estimation?
Yeah, I think that another 25 basis point hike today is likely. Of course, we've got the uncertainty in the backdrop of the banking sector to contend with. The Fed certainly will be paying close attention to that. But we have seen that the Fed's stream of rate hikes over the last year and a half have been starting to weigh on the economy. We had that disappointing US labour market data yesterday, the JOLTS figure hitting a near 2-year low. And of course, the CPI data has been coming down. It's at 5% now for March. It's 9th consecutive decline. So clearly, these rate hikes are starting to take hold within the US economy and indeed the US dollar. So perhaps this could be the final rate hike for a while.
OK, Victoria, got to leave it there, I'm afraid. Good to see you this morning. Thank you. Bit of breaking news to bring you now. Not terribly happy news, I'm afraid. Serbian police have confirmed that 8 children and their guard have been killed in a shooting at a school in Belgrade, the capital. That is the current scene on the ground there. More on that as we get it here on Sky News. Still to come here on Ian King Live. Pandora, the world's biggest affordable jewellery retailer, has predicted a good year for sales. I'll be hearing next from its chief executive. Welcome back. Pandora, the world's biggest affordable jewellery retailer, said this morning that sales this year will be better than expected. The Danish company, best known for its customisable silver charms and bracelets, reported sales for the first 3 months of the year of 5.85 billion Danish kroner. That's £692 million. It was up 3% on the same months last year. Well, while the United States is the company's largest and most important market, I asked the chief executive, Alexander Lacik, what he'd been seeing in China.
China, as you know, has been kind of in a lockdown mode for quite some time. It reopened in January, and actually Q1 has been sequentially better and better. Actually, in April we posted a positive like-for-like growth for the first time in many months. So that's kind of a plus. However, I can see that the kind of comeback of the middle market customer in China is much slower than what we experienced when we came out of the pandemic in particular here in Europe, where we quite quickly came back to pre-pandemic type of behaviors. It's happening in China, but at a much lower rate than what we've seen.
And what have you been doing with pricing so far this year? Have you been able to recoup all of your costs?
So we did some pricing action in Q4 of last year. So on average, we raised our prices by 3 to 4 points. We also assumed that there would be an elasticity, which would say what you gain on the top, you lose in volume. So the elasticity would be 1. But structurally, then, of course, your profit and loss statement ends up in a slightly better place than before. And that benefit is then there to offset some of the rise in inflationary components. We haven't done any more than that. We're going to see it through this year, but we're quite pleased with the reaction. It was as we had expected. So that's a pretty good outcome for the brand.
You've been putting a lot more emphasis recently on design. What kind of things have you been doing?
So we have a couple of platforms, as we keep talking about. There's Moments, which is the charms and bracelet platform. We've introduced a new bracelet for the first time in 20 years. We've designed a new studded chain bracelet, and that has had a very positive reaction from the market. Then, of course, we keep bringing new charms and charm innovation. So there's nothing spectacularly different there necessarily. Then on our timeless range, it's more timeless type of jewelry. We've, for the first time, introduced a little bit of heart-shaped and put some color into that range, which had a very nice reception during the Valentine's Day. And then on Pandora Me, which is the linked bracelet, we're bringing more charms into that range and some additional products. So that's kind of on the existing line. Come Q3, we're going to expand our diamonds range quite substantially. So those are probably, in terms of in the design and product area, the interesting news coming to consumers this year.
Now, last year you launched your first collection of lab-grown diamonds in the United States. Are you still seeing plenty of demand there?
Yeah, I mean, this is a long game. One has to be aware of, because we're entering the smaller portion of the diamond market. Roughly 10% of all diamonds sold today are in lab created. This is, however, growing at an interesting clip, and it's new for us. So our entry into this is really strategic, and it's going to take a bit of time, but we can definitely see that there's continuously greater and greater interest in this proposition being offered by Pandora.
Diamonds only account for around 36% of global jewellery sales right now. Do you think that has scope to increase with the advent of lab-grown diamonds?
I mean, if you think about it, today, if you want to buy a diamond, that's out of reach for many consumers. When Pandora and other people in, let's say, in the middle of the market introduce this, it comes at a different value proposition. So if you kind of think about that, then very likely you can see an expansion of the number of carats being sold to customers going into the future. That is not an unlikely development.
Time now for a look at this morning's business pages, and the Financial Times splashes its print edition with yesterday's sell-off in education stocks, including Pearson, following a profits warning from Chegg, a leading player in the market, in which it said that interest from students in the AI chatbot ChatGPT was hurting its sales. The FT is currently leading its digital editions, meanwhile, with a report that a Russian spy network has acquired sensitive technology from EU companies to fuel Vladimir Putin's war in Ukraine, even after a US-led crackdown on the covert smuggling ring. Well, the Times leads its business pages with the FCA's proposed changes to listings rules. It also reports on its business front page that Dyson is to spend £100 million on a new technology centre in Bristol as part of a 5-year programme of investments totalling £2.75 billion. Well, that story also makes the business front page of the Daily Telegraph, which also reports that Dyson is planning to build a next-generation battery plant in Singapore to power its vacuum cleaners and hairdryers. But the paper leads with the FCA's proposed changes to listings rules. No time for a paper reviewer today, I'm afraid, but a reminder to check out the Ian King Live podcast, which you can find by scanning the QR code on your screen now. It's available now wherever you get your podcasts, including the Sky News app, Apple and Google Podcasts and Spotify. Well, still to come here on Ian King Live. The travel platform Trivago's posted a rise in sales this morning. I'll be speaking to its chief executive after this short break. Stay with us.
So we went to the Yorkshire Three Peaks, and there were 68 of us who attempted to do the Three Peaks. Some of us managed the 2 peaks, and actually quite a big group managed the 3 peaks. We had the most horrendous weather. It really was the hardest challenge we've ever done as the charity. And I mean, from 5 miles in, we were walking in puddles inside our shoes.
Wow.
It was just wet completely through. And I think to see all these people do this walk, and I had one of the guys who did it text me afterwards and said, look, I got to the top of one of the mountains. I thought, I can't do any more of this. But then I thought about Ian and the boys, and I thought what they'd been through, and with them in his mind, it just kept him going.
You're raising money, so they can donate money, can't they?
Yeah, they can donate money through our page, which I can't remember the...
OscarsPBTC.org. Yeah.
Say that again, that's quite complicated.
OscarsPBTC.org.
OK, yeah. Fine. We'll make sure that we put that on our Twitter a little bit later on. Tell me...
can take part in the events as well, can't
Yeah,
they?
tell me about... I was
going
to ask you about other events. What other events have you done?
We've done Snowdon a couple times, Scarfell, and then last year we did Ben Nevis.
Did you? Which did you find was the trickiest?
Out of all of them, Ben Nevis.
Did you?
But this one's definitely taken the top of the hardest.
Because of the weather, do you think?
Yeah, probably.
Yeah, it sounds as though it was really, really difficult. How much money do you think you've raised for this charity?
I'm pretty sure we've raised about £20,000.
Wow, that's amazing.
I think if we make it past £22,000, it'll be the event that's raised the most money for us ever.
Welcome back. Now, the travel industry recovery from COVID restrictions continues. Trivago, the global hotel search platform, says demand's been robust during the first quarter of 2023. The German-based company, which offers accommodation in more than 190 countries, posted a 9% rise in revenues to €111 million. And that's up on the same period last year by 9%, as I say. Joining me now is Trivago's Chief Executive, Axel Hefer. Axel, welcome to you. What's been happening to average booking values?
I mean, if you compare to last year, prices are up. Yeah? So we see the impact of inflation, obviously, of course, in travel as well, and also on the price of accommodation.
It's anecdotally, it sounds as though American tourists in particular are back in Europe with a vengeance. What are the hotel categories they go for the most?
Yeah, I mean, I guess if you pay for an intercontinental flight, you're more likely to go for an expensive hotel. And you're 100% right. You can see the impact of the exchange rate movements in the travel patterns. So Americans are more likely to go to Europe to leverage the better exchange rate, and Europeans are less likely to go to the US compared to last year.
Obviously, China has reopened this year as well. Has that been a big driver of sales for you?
Yeah, Asia is actually very interesting. I mean, we are not active in China, but China is obviously a very important destination for a lot of our Asian platforms. Taiwan, Singapore, Hong Kong, South Korea, Japan. The other big driver of our Asian business has been the reopening of Japan in the last couple of months. And we expect a very, very strong recovery across Asia for this year.
It's been very striking. Japan is working quite hard to market itself as a tourist destination in a way that I can never remember. Does that have much resonance with consumers yet? Is it gaining traction?
Yeah, absolutely. I mean, we are very happy with the performance of our Japanese platform, and it's both outbound and inbound traffic into Japan that has picked up a lot over the last couple of months.
Have you been at all taken aback by the strength of demand given the sheer number of interest rate rises we've had in the Eurozone, in the United States, in the UK, just about everywhere? It doesn't really seem to have affected demand.
Yeah, I mean, it has to a certain extent. I mean, we just ran some user research in the UK, and more than 50% of Brits are willing to tap into their savings. So like in the last 2 years, where people have used their savings for their vacation. That's one side. The other thing is that we see a change in behavior. So we see that travelers are going for slightly shorter trips, and we see that they are going for cheaper destinations. So as an example, Spain is losing at the expense of Turkey for a warm summer beach vacation. London is losing at the expense of Istanbul. So travelers are going for slightly cheaper destinations that offer a very similar experience.
You mentioned London there. There's a big debate going on in this country right now about the fact that the government has taken away VAT-free shopping, VAT-free shopping from visitors. The luxury goods sector and the hotel sector here are very upset about it. Do you think it's having a visible impact on tourist numbers in the UK?
I mean, on the absolute tourist numbers, I don't think it will have a big impact, to be honest. It will have an impact on a certain traveler segment. Yeah? So those that are going for luxury shopping, so the top end of the market. So I do think that there is some risk for certain kind of retail outlets, certain hotels. But for the overall market, London is our top destination globally. So everybody's going to London, not only the ultra-rich.
And briefly, Axel, if you were pleased, what about the competitor landscape? I mean, over the weekend, Hyatt Hotels has just bought Mr. and Mrs. Smith. Are you seeing more competitor activity?
So we do expect M&A in the market. Actually, people have expected more M&A for now quite a while. On the hotel chain side, their consolidation has happened before the pandemic, and I think that will continue. And it will help hotel companies to take out some costs and to leverage economies of scale.
OK, Axel, we have to leave it there. Appreciate you joining me today. Thank you. That's it from me. There's much more on the Sky News mobile app and on the website with reporting, video content and analysis from our business team. Well, I'm back at 10 o'clock tomorrow morning. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Jane Secker with, of course, all the build-up that we get at this time of the week for Prime Minister's Questions. Thanks for joining me today. Cheerio.